Good morning, everybody. We'll get started at 9:15. Again, if you're here, thank you for being on time. If you throw your cameras on, it's great. Love to see your pretty faces. If not, you're in the car. Totally understand. We get it. Today is my first time doing this training topic. It's topical. I'm going to kind of wing it. Hopefully, we'll get some good notes taken and we'll have some more things to disseminate next time. But the topic here is based on the following. First of all, I still believe very much in both owning a home as a personal real estate investment and investment properties is the best way to invest money. And we're going to talk a little bit about that today. As part of that same thinking, and there's many reasons for that, and some of them I talked about on the podcast I did with Ninja. If you guys had a chance to listen to that, I hope you did. But a big part of that is how the federal government treats mortgages, both in terms of subsidizing them and in terms of the tax deductions that come with them. And yet, in spite of that, what we saw last month was 31% of all home purchases were made in cash, right? And I don't think a lot of that was like due to fake cash offer type stuff or whatever. And so that's up from 27% last year, and that's continued to rise. And when we think about that, it's like, well, let's talk about the psychology of why somebody would buy a home in cash to begin with, and we can have that conversation. And then further from there, talk about is that a good idea or why it's not a good idea? And I want to arm you guys with some information on that. And there's a couple different reasons. One is you may be able to see or find some people that you know, and maybe even do some public records, data type searches in your area. There's ways to do this where you can see who just bought their houses in cash, and you can reach out and try to do delayed financing with them and have some conversations about what to do with that money. But whether you think home prices and the markets will continue to go up, or you think there's a major crash coming, I can make a really solid argument either way that using bank money to buy and leverage your real estate versus your own money is the way to go. And we're going to talk about that for a number of different reasons today. Now, this does not apply to everybody by any stretch of the imagination, but it does apply to the vast majority, and particularly people who think they're savvy with money or savvy investors, right? You'll never find a financial advisor that will tell you the best thing you can do with all your money is to pay cash for a house. That's not a conversation any financial advisor would ever have with you. So this is not like a Mark Gordon unique take. Why do people generally pay cash for houses? Or why do people, you ever meet somebody who's like, I have 6 more years left and I'll have my house paid off free and clear. What is the psychology behind that? Pretty simple.
No monthly debt.
No monthly payments, right? Right. And especially for people, if you're somebody who has a fixed salary and you get a certain amount of money every month and suddenly your mortgage is paid off, you don't have a car payment or a mortgage payment anymore. That's real money into your pocket. It's disposable income. It feels really good, right? Any other reasons why we think this is why people are paying all cash for their mortgages or for their houses?
Just so they don't have to pay a bank interest.
Right. That we don't. I don't want the evil bankers to make money. The psychology of that, right? I don't want to be beholden to somebody. What else?
Say this day and age to be competitive in offers.
What does that mean?
So they can do a quick close, beat out all the other contingencies, and win the home versus 15 offers.
Yeah, I think that was definitely happening for a while there, and that comes back to my delayed financing. And by the way, that's a different scenario, right? If I'm going to temporarily go with a cash offer to give me an advantage in getting a house or getting a lower price, that makes a ton of sense, and we can have that. It's a different conversation, but I agree. Any other? And I think markets are far less competitive right now than they were a few months ago. At least mine is. Any other reasons? So, but imagine this: a third of all homeowners, right, that went and bought last month, almost a third bought with cash. So we're going to talk through. Go ahead.
I was going to say, they don't want to go through the mortgage process either. It might be too difficult, especially if they're an investor and own too many homes.
Okay, sure. It's a difficult, annoying process. Anything else? Well, how many of you guys have had somebody, you ask your realtor like, hey, I haven't seen referrals for this, and they're like, oh, I'm getting some cash buyers, right? Is your realtor discouraging people from making cash offers? No, why not? Because if they're there, it's like, I have a stronger opportunity to get the house that I want. It's going to make my life easier as a realtor to not have to have this mortgage process involved. And so there are a lot of things that we should be talking about. We need to educate our realtor partners on why that may not be the best decision for everybody, or on the delayed financing option, which can allow somebody to go in with cash. Or, by the way, we have our cash offer process here that we have through, what's the name of the company? Power Buyer. our Power Buyer program here where we can kind of offer cash without offering cash that we can go through on that process. So I kind of want to talk through some of the different reasons why it's not a great idea to buy cash. We're going to talk about primary residences. We're also going to talk about investment properties, because I think many of those people who bought cash, I think we're also in the investment property bracket. And we're going to do some quick math. I'm going to do some screen shares with you guys and show you what I'm talking about. Feel free, again, this is the first time I've done a training on this. So if you have some additional things to add in or things that have worked for you in the past, raise your hand, scream out, yell and shout, do whatever you got to do. I'd love to hear from some other people on this. But essentially, we know that there's opportunity here to get loans from people to get loans to people who are buying right now that are currently not getting mortgages. So let's just talk about it from a strictly like an investment portfolio thing here. And I want somebody to walk through an actual scenario with me here. So let's just do it. Actually, I'm going to start on the other side of this. You guys all see my screen right here? So we're going to buy a primary residence. We're buying our primary residence in cash. Okay. So if I buy it in cash on that, so I have a $300,000 house, I'm putting out $300,000 versus if I put down $60,000 and I have a $240,000 mortgage. Mortgages, by the way, for people who have cash to put down, many of them are in higher tax brackets. The reason this is important is since 2017, most people are using an automatic write-off for their tax returns. I'm drawing a blank on the term I'm looking for right now, but there's a standard deduction that you have on your taxes. And so for many people, mortgage interest is no longer tax deductible. But for high income earners or people that do have the money to pay cash, they're often still in an itemized tax bracket. And we know that the paying interest on the mortgage is tax deductible. So even if you're at 6.5% today on a 30-year fixed, your effective interest rate for those people that are borrowing the money is probably more like 4.5%, because they're going to get a third of that money they paid in interest back as a tax deduction. Does that make sense, everybody? In terms of, does everybody understand how that itemized tax deduction works on the interest? Okay. So another taxable return investment is the stock market or the S&P 500. You can see here on my screen here, there's some information here, but if I look at the last 20 years for the S&P 500, does anybody know, 20 years is a long time, by the way, it's a big sample size. What is our average return on the S&P 500 annually? Anybody know? Cheat, look at my screen if you want.
8%.
Yeah, actually over the last 20 years, depending on what if you're looking as of August 9th, we're looking at an average 20-year return of 9.67%. And that's with this not being a great year for this stuff. Okay. So that sounds, by the way, like every 10 years you double your money, but it's actually significantly more than that because that interest compounds, right? It's a compound interest return. And so there's tremendous upside of those 9.6% returns. So by simply, my return on investment today, if I pay cash, is a taxable or tax deductible 6.5%. That's my interest rate. So I'm really saving myself 4.5% in interest by paying for my house in cash. But if I took that same $240,000 on that $300,000 house, okay, we're gonna talk about how to explain this to realtors better than I'm doing right now. Then I can, on that $240,000, I'm gonna make 10% or 9% returns on average. So let's just use 10% as a number that makes sense, right? So if I'm 4.5%, let's just do 6.5%. So what's 6.5% on $240,000? Anybody have a calculator that we can do this with real quick? I can do it. $240,000, 6.5% is $15,600. That's the amount of interest somebody will pay, maybe a tiny bit less than that because they pay off the principal through the first year. They're paying $15,600 in interest on that mortgage, okay? Now, if that's tax deductible, I'm actually only paying 70% because I'm going to get the rest back. So my out-of-pocket interest is $11,000. So I would have saved, so by paying cash, I saved myself $11,000 versus if I got an 80% mortgage. Everybody follow me on that math? Talk to me if you don't. Great. Now, if I take that same $240,000 and I earn 9.6% on it, that's $23,000 in income. And at that same tax rate, my net gain is $16,000. So that's a $6,000 annual difference, or an extra $500 a month in net worth value on average that somebody would make by taking out a $240,000 mortgage, even at these higher interest rates we have right now, on average over time by investing that money. And by the way, this is never be a good investor. This is just buying a simple index fund of the entire S&P 500. You're basically taking an average of the 500 biggest companies. You're earning that 9 to 10% average. So $500 every month, that's for a $240,000 mortgage that I'm adding to my net worth by taking out that mortgage and investing versus the alternative. So now somebody give me a normal counter argument somebody might have to that. Because there's a million reasons why that's not. Mark, that's great, but what's my but?
Well, Mark, aren't you assuming as well that that they're exceeding the standard deduction for itemizing obviously the write-off for the taxes and their interest?
I am, and I'm saying if you have all this money in cash to pay for a house, I am saying you're probably doing an itemized deduction. If you're not, that might even up the numbers a little bit, for sure. But that's a good answer. So let's just say they're not, then it's a lot closer. But I understand what you're saying in terms of the itemized deduction. What are some other counter arguments? There's some good ones. Mark, I think the stock market's about to crash. I think it's going to go down. Okay, it's too risky for me. The real estate market feels safer to me. Seems like a reasonable argument to me, right? So let's look at really safe investments. Municipal bonds are also tax deductible, meaning you get to keep the money that you earn on them tax free, and many of them right now are paying 4 to 5%. Okay, so again, if you're paying 6.5% and you're not getting any itemized deduction, this might not apply to you. But if you are getting an itemized deduction, you can essentially keep your cash on the sidelines, right? Because municipal bonds are super easy to trade in and trade out of, right? And basically earn on your tax-free municipal bonds the amount of interest that you'd be paying on your mortgage and still keep yourself liquid because of the opportunity cost that's coming. Because here's what's happening, right? If you think the market's about to crash, because that's the reason you go with this strategy, guys, and this is better to be an actor. I know what I'm talking about is complicated. It's my first time training on it. So ask questions. I think the stock market's going to crash. Municipal bonds are safe, right? And as long as every town in America isn't going out of business or every state in America is declaring bankruptcy, which most of these states have laws where they can't even do that. Okay. This is about as safe an investment vehicle as you can get. But so if I think that stock market's going to crash, why then is it even a smarter and better idea for me to do something like buy municipal bonds and then be able to liquidate those quickly moving forward? Why is that a good idea? Somebody talk to me about investment strategy.
You can buy the dip.
You can buy who said that?
Ray.
Yeah, what'd you say, Ray?
You can buy the dip.
Yeah. Right? So what do we know? If you go back to 2007, 2008, 2009, so many people made a ton of money. If you had capital at that time, you could get huge discounts on things. You could have bought Citibank stock for 98 cents a share, right? And I mean, that's the discount that was available. And so when the stock market tanks or when the economy tanks, you have all these buying opportunities and cash becomes king, right? Because what you couldn't do is borrow money easily during the financial crisis. Nobody wanted to lend it to you. But if you had cash, right, then all of a sudden you could take advantage of all those opportunities at the bottom of the market. Further than that, the yields and the price of municipal bonds rises when the economy tanks because people are looking for safe places to put their money, and all of a sudden these become more attractive investment vehicles. So you may actually, not only are you getting a 4% return on your municipal bond, but you might be able to sell it for more than you bought it for if you actually think that the economy is going to tank, right? And so if you think things are going to keep getting better, it makes sense to put your money in the stock market. But even if you're skeptical, you think things are going to get worse, there's a perfectly safe place to put your money here where you can earn returns. Now, here's the other thing. What do we know about the interest rates? Well, you're locked into 30-year fixed. If rates keep going up, you're protected. And if rates going down, you can refinance and take advantage of those lower rates. And so by not having cash or by locking your cash into your real estate as opposed to having it on the sidelines, you're making it harder for yourself to take advantage of the opportunities that might come up if you think the stock market is going to do anything that's too risky of an investment for you. Questions? Now, these are both really conservative investments. And what I mean by that is municipal bonds, it's like, hey, this is really safe. Give me my money, right? S&P 500 means like no skill involved. I'm buying every company in the S&P 500 and I'm still earning 10%. But what if you went with a low cost fund managed by somebody who was better than the S&P 500? So these are Fidelity. This is just right off the Fidelity website. These are all of their different places you can invest their money. And I think through our 401ks, you can invest in some of these accounts here at Princeton as well. And I want you to look at the 10-year or lifetime averages of appreciation in these index funds. Now, again, if you look, these are all down huge this year. And that's already being factored into this number here. So this is the amount they're up even after tremendous crashes this year. Okay, that you can see here, right? 16%, 15%, 13%, 11, 10, 12, 11, 17, 18, 15. You see them all here. Nothing, 6 is the lowest I've seen so far. And so obviously here, there's tremendous opportunity in many of these to over time really outperform, right? And even on, even with these huge hits, even on the 3-year and the 5-year, you still see annual returns. These are annual average returns, cumulative returns over that time period. And so what we're saying there is that, hey, yes, mortgage rates might be higher right now, but there will probably be a time where you can refinance into a lower rate. And by putting your money into one of these funds here, right, you can make significantly more than the interest that you'd be paying on that mortgage. And by the way, this is why if you have a financial advisor, they would say to you, Mark, you're crazy for paying all cash for this house. It doesn't matter if you have $1 billion, right? You're better off spending that $1 billion somewhere else if you can borrow money this cheaply, right? We can borrow money super cheap. Questions? How many of you guys are like, that's great, Mark, I want to pay off my mortgage. I don't like my bills. You can tell me the truth.
So
this is still, go ahead.
Mark, how do you, so the conversation, if it sounds like when you're having the conversation, most of these discussions are all long-term strategies. So you have someone who says, look, I got my money on the sidelines right now because the best I can earn, if I'm lucky, is 1% in the stock market currently, or possibly lose money in the stock market currently, as you can see on those 1 year or year-to-date returns. How do you have the conversation with someone who's looking more short-term for their objection to this strategy or to this conversation?
I'm really glad you brought that up. And by the way, so this is actually my favorite answer to the question. And this is I'm going to show you my investment strategy for me personally that I also then try to engage with everybody else. Okay. So somebody, by the way, investment properties do not have to be in your market. So the scenarios that I'm going to go over with you, the opportunities like this exist all over the country. There are many opportunities for this, and we'll show them to you. So if in New Jersey, for instance, investment properties are really hard to make work because the property taxes are astronomically high and they ruin your conversion percentage. However, in South Carolina or Tennessee or Alabama, there's a million opportunities to get huge returns on cash flow. And so you don't have to be in your market to do this, okay? So here I'm going to give you a purchase price of $300,000. Everybody here know basically, so we're doing a down payment down of $60,000. Loan amount is $240,000. What's my rate today on an investment property? 6.5 with some points, maybe some fees. We'll figure it out. Give or take. We'll go with that for now.
6.8, 10 points.
6.8, 10 points. Here, let's do 7% just for fun. So what's my principal and interest mortgage payment? We'll do some quick math right here on $240,000 at 7%. $1,600 a month. Okay. We're going to add in for principal, interest, taxes, and insurance. Here in South Carolina, you're looking at about an extra $250 a month, or maybe let's call it on investment property, $400 a month in taxes and insurance on a $300,000 house. Let's say we want to be conservative and say it's an extra $500 a month. $2,100 for our total monthly payments. Okay. Our rent received is $2,450, which gives us positive cash flow of $350. Okay. And then here's what we're going to do here. $350 with me here times 12 is what? $4,200. Okay. So what is our cash flow return on $60,000, $4,200 on 60,000 that we put down? 7%. Okay. So this is a scenario here, typical scenario here. And by the way, I'm looking, this number here for me, 7% is usually not enough for me to do this deal. Normally what I'm looking for is targeted return on cash of 12%. That's for me. So let's look at this same scenario. Okay, if we put the $300,000 completely out in cash. Okay, so now our cash is 300,000. Our rent received is $2,450. Okay, I still have my $500 a month in taxes and insurance, so I'm paying $1,950. So I'm still paying $500 a month, but my return, my cash flow return in this scenario would be $1,950. Is everybody with me so far? Right? Because I'm still paying $500 a month in taxes and insurance. So my return, my cash flow is now $1,950 in that scenario. Right? So now we're looking at $24,000 a year. My $24,000 a year here, divided by my 300,000 that I put down is 8%. So if I put all this money down, my cash flow is now 1% higher than it would be if I just put down this amount. Okay. So it's pretty even, right? That's why I'm always looking for 12% on my return on this, which is why I wouldn't do this deal unless I thought I could get $2,700 a month in rent. You guys with me so far? But here's the thing, right? Let's imagine now that you buy this house today and you're getting 7% return. If rates go down to 4% again, do you get more than the 8% return that you were getting here before, or are you still getting 8% on your 300,000? Am I going too fast? Talk to me. Am I losing people? If I pay this house in cash, this investment property in cash, my 8% is 8% even if rates go down. Okay. But let's say rates drop to 4% here. Okay. What does that do to my principal and interest, taxes, and insurance payment on the same $240,000?
It lowers it, Mark.
Look at you, Fred. Let's do some quick math. Now my payment, instead of $2,100 a month, is actually only $1,645 a month. Now my cash flow on this isn't $350. Okay. My cash flow in this scenario is what, guys? $805 a month or $10,000 a year. On my $60,000 investment, that's a 17.5% return that I'm getting on that. And now that's where I'm at over my 12%. And so over any sort of time period here, if rates go up, that means rents are also going to go up because you're seeing inflation. If rates go down and we can keep our rents the same or relatively stable and we save that money on our principal and interest payments, you see why real estate is the best way to become a millionaire. Now, here's the other part of this that we're not factoring in. Okay. I can only buy one house for $300,000 if I use cash. I can buy 5 houses if I put 20% down on 5 houses for this 60 grand. And by the way, these percentages don't change if I buy 1 house or 5 houses. Those returns are the same. Okay. So let me say that again. Those returns are the same. So if you believe that at any point over the next 2, 3, 4, 5, you can get basically the same return on your money today, whether you use all cash or you borrow the money. But if you think rates are ever going to go down, you're going to have an opportunity to increase that if rates go down, if you borrow the money versus if you lay that money out as cash. You can also buy more houses. So here's another thing I want you guys to look at. Home percentage appreciation is somewhere between, let's call it 3% annually over time nationally. Okay. So if I buy one house, what's this house worth next year at 3%? 309. for all my math majors out there. Didn't need a calculator for that one. Okay. And that's compound. So now next year, my 9% or 3% on that is even more than just the $9,000 a year that I'm making. Okay. But I only have one house because I paid $300,000 for it. I'm only making $9,000 next year on average on that 3%. If I buy 5 houses, 9 times 5 is $45,000. So in addition to the fact that I can buy, these returns are almost the same. Okay, the 7 or 8% almost. And by the way, keep in mind that my interest is tax deductible in my scenario. So this actually probably is the same when you're factoring in tax deductions, right? The 7 or 8%, it's like the same because we're gonna get some of that cash flow back on our tax returns. Okay, plus depreciation on the investment property, we get some of that back too. So we should be in good shape. But if I can buy 5 houses for 300 grand instead of 1 house for 300 grand, now I'm making an average of $45,000 in equity on my 300 grand as opposed to 3%. So I can either make $9,000 a year in appreciation on 300 grand or 45,000. 45,000 is a 15% return on my money. So if I can, so this is where the math gets crazy. And this is how I actually buy my investment properties. Okay. So when I do this scenario here, I'm not getting 17.5%. Most of these I'm starting out looking for a 12% cash on cash return. So I'm going to delete all this and we're going to kind of run through it again to make it a little less confusing. And by the way, for all you guys who know somebody who's self-employed who got a bunch of PPP money and they're buying crypto, this is the better scenario. This is the safer way to invest in money. This is how people become millionaires. It's leveraging your money. So same scenario here, right?
And Mark,
Yep.
so too, if they paid cash, they're ultimately going to pay more in taxes on their tax return too, right?
That's what I mean. Right, exactly. So you're not going to get the same tax deduction on the income from the investment property. Exactly.
Okay.
And I'm sorry if I didn't make that clear. That was one of my things, right? So we have these 3. So now we buy this house, right? My rate is 7%. My principal interest payment, what did I say it was? It's $19.50. I said right? Something like that. Does that sound right? Somebody help me. My rent received here. So
It was 2,100.
2,100. Okay.
No, 2,450.
That was the rent. And then 2,100 was the payment, right?
Right.
Right. So I'm only doing this deal, guys. And I want you guys, I understand I'm throwing a lot of numbers at you here. I'm only doing this deal if my cash flow on my $60,000, right, is 12%. So if I need to make a 12% return on 60 grand, how much extra money do I need to earn on this each year? What does my cash flow need to be for the year? What's 12% of 60 grand? Somebody look smart and $5,000, right? Nope, $7,000. Who's paying attention?
7,200.
$7,200. So I need to make $600 a month. So I'm only going to buy this property if I think I can get rent of $2,700 a month for a cash flow of $600 a month and 12%. Okay. Now here's the magic of that, right? Not only am I getting a 12% cash on cash return, but I'm also going to get an extra $9,000 here, right? Because we know on average we're going to go up 3%. And by the way, in the markets that I'm buying, it's not 3%. It's significantly more, right? I'm buying in the South. Home prices are going up. We see those different things. So I'm getting that different amount. Okay. So I'm getting that $3,000 here. So I'm getting $9,000 here, and I'm getting $7,000 here. Does that make sense to everybody? So now my net income to my net worth. My net worth increase, okay, is 7,200 plus 9,000 equals 60,200. On my $60,000 investment, I'm now making a more than 25% net worth return annually, right? So if I take this 16,200 here, I'm going to figure out how to teach this in a better way. So I appreciate you guys being my guinea pig, but I know it's worth teaching. That's exactly 27%. So my net worth Now, maybe there's some expenses I'm subtracting here for the property, by the way, and maybe there's some, but also some tax write-offs that I think equate to some of those things or whatever it is. But I'm getting a 27% return net worth each year on this, and that's in year one. That's year one. Now, what's even crazier about this is that this compounds and rents generally go up. So what do we know it's not going to go up? My principal and interest mortgage payment is never going to go up. It can only go down. It can go down if rates go down, right? But it cannot go up. I'm locked in on the principal and interest side of this, right? But rents do also go up. So this 27% return that's in year one is now going to go up slightly here every year because now we're going to compound on this 3%. Next year will be 3% at 309, next year 3% at 319, next year 3% at 330, and we kind of keep going up from there on average, right? But also my rents are going to go up and my mortgage payment might go down. And so by now, if I can do this over 5 properties instead of 1 property, you can see how quick you can build wealth on that 300,000 by doing this. So if I'm getting 27% return on this 1 property, right? Well, if I can't do that if I don't have any more cash. If I want to keep buying properties, I want to leverage myself here. What's even crazier than as you go, let's say 10 years from now, you look at the same situation. 10 years from now, what's the value of this home? It's like 400,000. And the mortgage is paid down to like 215,000 or 210, right? So now I have almost 50% equity 10 years from now, and now I can borrow against this property to buy more properties, right? Whether we do a cash out loan, home equity line of credit, or even we do some commercial type loans through banks that will lend against multiple properties and give you cash to do loans. There's other creative ways to finance this. You can now use this to get more down payments for more houses. And so you want to know, how does somebody build a huge portfolio where they own 50 homes? It's the compound approach of doing this in a very real way over time. And so I can tell you, even in my short time of being a real estate investor, these 27% returns, this has been low for me. I'm actually making more because I ended up getting more rent than I expected in many cases, and I get more appreciation than I expected in many cases. And so these are just based on the averages. So what you're looking for are markets, and by the way, I can show you the same thing works at $100,000, by the way, right? And it's actually sometimes it's easier with $100,000 properties to get these returns to make this work. What questions do you guys have? You guys want to look at one at $100,000 and see what it looks like? Or somebody who might want to start smaller on this?
I want you to, can you do one like on just a regular primary residence? Because I have a guy that's going to put a lot of money down on his primary, and it would be a good thing to talk to him about.
2 things that. So the primary thing, there's other pieces of the equation on primary residence. And the biggest one is, can they afford the monthly payments from a cash flow basis, right? Because all of this is great because our net cash flow is positive because we're renting this out. And so our mortgage payments are covered by the rent that we're receiving. You have to be able to see somebody's entire financial picture when you're talking about a primary residence, right? And so if the answer is, hey, my husband died and I got $1 million in life insurance, but my income is just Social Security at $3,000 a month, that's now a different equation potentially for somebody on their primary residence. Now, I can still make the argument, and by the way, I did this for my mother because she was in this situation where I used that money to buy investment properties that then cash flowed positive so that she could pay her more. Instead of just living off that $1 million, she's now making money by having investment properties. Some of them are short-term rentals, some of them are longer-term rentals. We went through this exercise, but it is a different equation on primary residence. And so I'd have to know somebody's entire scenario to start poking holes in why it doesn't make sense. But people have to be able to afford that monthly payment, right? And so is there more about that person? Like, is that person still working? Do they have good income? What's the situation with that person?
He has good income and, high credit, and he's moving here from California, and he's a retired police officer. So I think he's fairly young, but I have a feeling he's going to start working again, but he makes like 120 in retirement and has some money in the, investment.
Yeah, so my appeal to that person would be, hey, where else could you put that money where you could earn a better return than a tax deductible 6.5%. Because your best case scenario on getting a mortgage right now is that you're earning that tax deductible 6.5%. If that guy's got other investment incomes, or he's going to start working again or different things, I don't know what his itemized tax deductions might be, or if he's taking the standard deduction, but those are some things to work through. And so on the primary residence, a lot of it comes down to personal comfort with the monthly payments. If somebody's interested, and by the way, I would find a financial advisor locally that's on board with this strategy with you, that you could push people towards if they're having questions about what they could do with their money and where to go. So now all of a sudden you're not the one just giving financial advice, but you're partnering with somebody, and then you guys can exchange referrals back and forth. Make sure it's somebody that you think is going to do a really good job and make you look good. Don't just find somebody that's like, okay, find somebody that you're in love with and you think that your clients, if they love you, will love them. But so it's not as an apples to apples illustration. But again, if that same police officer could take some of that money and buy 2 other investment properties that would cash flow in this way and maybe pay his mortgage payment for him, right? So instead of having a smaller mortgage payment because you're putting this money down, can you buy a couple of investment properties that cash flow enough where you're having effectively 0 mortgage payment? And then that could be your conversation with him in terms of a cash flow basis, right? Plus you're extending yourself over real estate in a different way. And so I have to be able to see that in person's entire financial situation to go through it. But I think I could probably, if they were open to hearing the conversation and willing to do the work, by the way, of finding investment properties and doing this, a financial strategy that does make sense. And a lot of people just don't know how this works. So I do want to walk through one that's here. It's at $100,000 so that you guys can see either for yourselves or for somebody that maybe doesn't have the same amount of means or is dealing with some of the same types of numbers. You can kind of see what these numbers start to look like. What's my principal and interest mortgage payment? $80,000 on 7%. Anyone got a mortgage calculator, or is it all on me? I feel like I'm losing people on this one. Am I losing you guys? I'm gonna get my worst scores ever. 532. And so, and let's say the taxes and insurance are not much, right? Let's say it's a $100,000 house, $832 a month, right? My cash flow for my 12% cash on cash return on $20,000 needs to be what? Not a lot, right? It's like even $3,000 in this scenario would be a 15% return. So let's say that we have to rent this for $1,132 to get that $300 cash flow. And now we're actually getting a 15% cash on cash return. Okay. Plus we're going to get this 3% here. So this is $3,600. So we're $3,600 a year in cash flow and $3,000 a year in appreciation for $7,600, which is a total return on my initial $20,000 investment of what? 38%. So that's your 38% net worth gain based on average returns if you can buy a $100,000 house right now and rent it for $1,132 a month.
Mark, where'd you get the 7,600? Shouldn't it be 6,600?
Yes, sorry. Good call. I'm doing it all quickly in my head. So we're at 33%, right? Is that correct? $33% though. That means if you give me 20 grand today, I'm going to give you an extra $500 in net worth every month. In this case, it's going to take you less than 3 years to make your initial investment back. On a cash basis, it's 6 years, 5 or 6 years, right? It depends on what you do with rent. If it goes up, if you get to refinance, obviously this all starts to look a lot better, right? But on a cash flow basis, maybe it's 5 or 6 years before you get your money back. But on a net worth basis, we're looking at less than 3 years before you're earning that $20,000 back. 100% return over 3 years. And so now, how many of you guys, if you really worked at it, could find a way to save 20 grand every year and buy a $100,000 house and do this? And then if you woke up at retirement after that strategy, how many millions of dollars would you have? How much cash flow would you have at that point to be able to do this strategy? This is an opportunity for investment that's available to everybody, right? Now, the one thing I'll say to you is you do want to have cash reserves that predict about a 10% loss on rent each year. So in other words, maybe one of your investment properties, the person stops paying for a month or two. You don't want to put yourself in a situation where if that happens, you can't make the mortgage payments and you're going to default because that ruins your strategy. So don't over stress yourself. Have some money put away just in case, or a line of credit put away just in case that you could borrow towards in that emergency situation. But this is the wealth building strategy that is most predictable over time. Because even when housing goes down, everything else goes down more. Right? And so this is, so you say, wow, you know, when I have friends who are like, I'm getting 11% year over year on the stock market. And I go, this is what we could earn. This is what you could earn if you did it in real estate. And they're like, I need to be investing in real estate. Now it's a little more work than just buying stocks, right? You got to find the place. You got to buy the place. You got to take care of it. You got to collect rent, do these other things. Maybe you have a property management company that eats into some of these numbers, right? We can talk about what that looks like. But over time, this is the strategy. And so by having somebody right now who's making the decision to go all cash, they're robbing themselves the ability to potentially take advantage of investment opportunities that are going to come up as the market cools off. And I do think we're about to head into a recession. I think cash is king in a recession. You want to be able to be opportunistic with your cash as those opportunities come up. I think there'll be better buying opportunities in the coming 12 and 18 months than there are today. I think it's likely. And at the same time, if you're going to buy a house today, this is why I wouldn't pay all cash. Questions? I will put together some things and notes that I think make this slightly more digestible. But I think as you can see here, these are all conservative estimates for what these returns would be over time. I say, Mark, there's no guarantees. What if housing prices go down? If housing prices go down, it means everything went down. There is no safe place to put your money, and under the mattress isn't an option. Right? Or it is, but it's a bad one. Cool, guys. Anything last minute here? Well, rate the training, give me feedback. Keep in mind, I did say up front that this is my first time going through this and you guys were the guinea pigs, so I appreciate you going through it. Let me know what went well and what didn't go well. Tomorrow, we're going to cancel our normal training time, and I invite you guys to come to the OKR training at 1 p.m. that I'm doing for the operations team for the whole company. If you guys can't make it, I understand, but if you can make it, I think it's a really good one as we prepare for our Q4 planning and setting our goals and our objectives and key results for that. If you guys have any individual questions, let's say if you're interested in this personally because you want to invest, feel free to reach out to me. I'll spend some time with you. I'd be happy to help in any way that I can and even point you in the direction of some target markets that I think would be worth looking into. I appreciate everybody's time today. Happy selling, and I'll see you guys tomorrow at 1.